Hello again, this is Alex with MasterChartsTrading.com, and this is Market Recap for Friday, January 15, 2016. This week I have quite a bit of new charts to show you, so we'll move relatively quickly. This S&P 500 ETF SPY is already retesting August lows, while S&P 500 index already put in a 52-week low. We'll look at MarketBread's index, a proprietary index that I use for setting the bias in trading, and we'll judge whether or not the market is oversold or not. Some of the many important economically sensitive funds hit 52-week lows this week. Bonds, even the short-term ones, are attracting quite a bit of money inflows, and the prices are pushing higher. Gold, but not GDX, is benefiting from all of this turmoil. Finally, we'll look at oil as it may be approaching a tradable bottom, and we'll look at several of the funds that I used to judge whether or not this is indeed going to happen. And natural gas gets rejected at resistance, and we'll look at that also. Alright, so this is S&P 500 ETF SPY, very highly traded fund and a very useful proxy for the market. So basically on Friday we are retesting August lows that were set here. Now this big spike here, I think this was a result of some sort of a flash crash event. So next we'll look at S&P 500 index itself, and it may show a slightly different picture. Nevertheless, we're attempting a retest of August lows, and this was a pretty significant selling pressure. All of this first 10 trading days of the month. Actually, it started even before the beginning of the year, last year, and in December, the selling already started. On balance, volume is hitting new lows, so this is confirming the move lower. So this is all quite negative for the general market. Also, this 50-day moving average, you can see, moved below this 200-day moving average. So many, even fundamental investors really pay attention to the moving averages, especially the 50 and the 200, and this is called a death cross. So when this happens, many of the long-term investors simply sell and step aside. So next, let's look at S&P 500 itself, and this is a index itself. So as I said before, S&P 500 actually hit 52-week lows already. And this is a 52-week low intraday that was hit on Friday. Also quite a bearish looking chart. This could be like a inverse cup and handle, and if this is indeed an inverse cup and handle, then we can do a quick measured move target with the inspect button here, and this whole thing is about 11%, so we can see at the very least another 11% down from today's levels. Now, as I said before, we're somewhat oversold, so I was actually expecting a bounce, this bounce to go ahead and not fail, and it did fail, of course. But we're quite oversold. You can see the percentage of stocks above the 50-day and the 200-day moving averages is already in a very low territory. The same goes for bullish percent index. So in the past, these types of readings, led to some sort of a rebound. But back here, I think we had a more just a bullish general outlook on the markets. And I think right now the general outlooks on the market is much more bearish. And in a few next charts, I'll show you why that is so. Okay, so this is a chart of S&P 500 going back to the 1990s, and what I did is I removed the price and I only left the 50 and the 200-day moving averages instead of them. And if you're just doing a trend following system, then this is already a pretty decent system. If you have a 50-day moving average above the 200, then you simply look for buying opportunities, and vice versa. If you have 50-day below the 200, you're looking for selling opportunities. But as you can see, you get those whipsaws that are marked by these pink boxes. So what I did is I created a market breadth index, which is composed of various trend, momentum, and market breadth indices kind of all rolled into one. And I already mentioned this several times before. This index is very useful in identifying market tops and bottoms, but additionally, it's very useful in identifying these whipsaws, the false trend signal changes. For now, it is signaling a bear market. So currently I think we're in a bear market. Next chart I'll show where exactly that happened, and this index actually called it quite well. But let's look down below here, and this is a what I call raw MBI, which is a raw input for this index. You can see it's much more volatile series. So this one is somewhat useful in identifying overbought and oversold conditions, and notice this is a very long-term chart. So these oversold and overbought conditions are useful at the market tops and bottoms. So for example, here in 2003 we had level of raw MBI actually drop below 20 here. This is an oscillator between 0 and 100. And then we can see that this indeed marked a bottom of some sort, and then we had a rally. The same thing goes here. We had a bottom in action in a raw MBI index in 2009, and then finally we had a rally that continued. Now, what is the current picture? You can see that right now we're at 47. And so we're not yet oversold. In other words, what I think right now is happening is we have quite a bit of room to correct downwards. And until we get the raw MBI oversold to raw MBI oversold levels, I'm not yet ready to say that we have indeed bottomed out. So we're currently at around 1880, around here. So we are already about 10% of the peaks, and we can continue correcting down. Now, this Fibonacci retracement, these blue lines here, are from the 2009 bottom to the very peak, last year, and you can see that they, show quite well a retracement area that we could correct to. So a shallow correction would be around 25%, and that would take the index back down to the previous two peaks around $1,500 rather. A more serious correction would be around 50%, so that would be around 1,400, and then a pretty deep correction would be 61.8%, so it will take it index down to around 1,200. But I think the important thing is to keep all of this and take it with a grain of salt, and we could also turn around and rally. So this just is one of the several possibilities out there. However, once again, my money is on the downside, and I'm looking for, I'm not seeing anywhere near the bottoming patterns as we saw here in 2002 or in 2009. So, if I was going to say that I want to see raw MBI in the oversold territory, that would be, a kind of like a comfortable level for me to say, okay, we are now definitely approaching oversold levels, and we may see a sizable rally. I don't think we're there yet. I think we're only in the beginning stages of a bear market that could continue for, it could be relatively brief, like it was in 2008, 2009, or it could be relatively extended, like it was in 2001, 2003, or it could be something completely different. The important point is that currently I'm thinking that we're in a bear market. Okay, this chart shows S&P 500 large cap index more zoomed in, going back to August of last year, with market breadth index MBA in the upper pane here. So you can see that it dropped below into the bearish territory right here in September, following this rally attempt. And then ever since then, basically, we have not been able to get back into the bullish territory for this index. My subscribers will note that I've been consistently bearish, starting around here, and I was shorting all of the rallies that S&P 500 attempted to do. Now the final one, of course, here is a we're currently right here, so basically this proves my point that I think we're in a bear market long term. Next, let's look at some of the other stock funds that I follow that shows that the picture is quite bearish, not only in the United States but throughout the world as well. So I'll be moving relatively quickly through the next few charts. This is NYA, New York Stock Exchange Composite Index. This is upper pane here is a new highs less new lows divided by total number of active symbols. You can see we really have a lot of new lows being set and very few new highs being set. So we're still quite bearish in that department. This is also possibly an inverted cuppers handle with a breakdown already. So we had a close below this neckline here. If we do break below, if we do continue lower, then the downside target could be, let me just do a brief measured move again. And this is about 10% down. So another 10%, from 9,500 area. So that's another 1,000 points. So about 85,000 for NYA. Also, we're hitting new lows in advanced decline and advanced decline volume lines. So this is quite bearish. Next, let's look at small caps. Small caps also are trading below the August lows, and they're at 52-week lows. This shows it's generally weak risk appetite, as investors are not really interested in small cap stocks, which are generally thought as more risky. Next is a XHB, Home Builders ETF, and this is a very economically sensitive fund. Also broke below August lows right here, and now at 52-week lows. So this shows a very poor outlook for home builders and consumer discretionary. This is a part of the consumer discretionary sector. Next is XBI, which is a diversified biotech fund, and also we had a 52-week lows and a break below the August lows. If you're a subscriber, you received an alert here, and hopefully you still have a position open here. The inverse position, of course. Next is a European ETF. Pretty much same thing. This is actually multi-year lows, not even 52-week lows. Very weak chart. Really a feeble rebound here of the lows, and then continuation lower. Next, let's look into emerging market territory. This is a diversified emerging market, one of the very popular ETFs. There's lots of volume being traded. Similar picture. This could be like an inverse. This could be a head and shoulders basically pattern, and a breakdown. Right there is a breakdown and a multi-year lows. Brazil, also one of the weakest charts out there. They're in continuous long-term bear market. This rebound was pretty much viciously sold, and again multi-year lows. Again, the same thing. Members received an alert here, and hopefully you're sitting on nice gains. And then finally, from the kind of winners in the downside perspective, is a Mother Russia ETF, RSX. which hit 52-week low. This is not a multi-year low because we had a really huge spike down back here. So this is 52-week low, 52-week closing low. This was a 7%, over 7% gap and run on Friday. Just extremely weak, and continues to be weak as well. So all of the previous charts basically show economically sensitive, important sectors, and foreign countries as well being in bear markets of various length, but bear markets nevertheless. S&P 500 is one of the few holdouts, but I think it's getting there, and I think the general tone of the markets is certainly bearish. Okay, so if everything is mostly in the stock universe is pretty much pushing lower, what's out there that's pushing higher? And of course, the logical place is bonds, and especially the treasuries, which are perceived as the ultimate safe haven asset. You can see that it is happening. So we had a breakout here above the previous highs, and this is a closing high for the past 6 months. So it certainly is happening, and the money is certainly rotating out of stocks and into bonds. And also TLT is now one of the market leaders. It's one of the highest SCTR, Stock Charts Technical ranked funds within the fund universe. So this is showing some serious appetite for safety. Next, let's look at BSV, which is a short-term bond fund, and this is a same picture really, as short-term bonds are also market leaders, and this is despite the fact that, the Federal Reserve raised interest rates, right here, and you can see that there was an attempt for the bonds. They actually sold off quite hard here in anticipation of the rate hike, but then they just kind of shrugged off this whole thing and rallied. So this is showing again appetite for safety. All right, next let's look at the other safety asset, the US dollar. Okay, so US dollar daily time frame, and this is a end of day chart. So again, we're there's 52-week highs here, and we tried to approach the 52-week highs, and then we sold off after Mario Draghi delivered his speech. But since then, I think we held support and continued higher. Now, if you are, I'm not terribly happy with picking tops or bottoms, but if you like that kind of activity, then this could be like a bear flag maybe, and if it does break down, then we could be looking at a maybe, I don't know, a pullback to around here, so maybe this support level again. But generally speaking, I don't see that's happening just based on the macroeconomic picture. It's pretty much all central banks around the world are easing, quote quote, printing money, while the Federal Reserve is actually doing the opposite. They're tightening the supply by raising interest rates. So I think the dollar is going to kind of push towards the highs again, or at the very, and possibly trade sideways. I'm not really big into currencies, but if you do like to trade currencies, this is kind of good, good to keep in mind. Next, let's look at gold. Okay, this is gold daily spot price end of day chart. So this is a multi-year low here, and then a counter trend rally. Well, I guess you could call it that. Just a lot of noise and a lot of back and forth feeling, really. At the end of the day, I think gold is still in a bear market, so I'm not even looking to pick bottoms. I'm only looking to short the overbought conditions. So maybe we'll get a rally to the 200-day moving average, at around 1140, possibly even to this 1160 area where there's broken support here. But generally speaking, I don't think we have yet achieved the true bullish breakout. I think a true bullish breakout would be a close above here, maybe at $1,200 and continuation higher, and then a pullback, and this support holds, and then continuation higher. But I don't think we're even remotely there. So, anyways, if we do get a rally, then most likely it will get shorted. Alternative scenario, of course, is just we could break down and then continue lower to maybe around $1,000, possibly below that. Interestingly enough, the gold did benefit from all of this turmoil and kind of traded sideways, but gold miners did not. So let's look at gold miners next. This is a GDX, Market Vectors Gold Miners ETF daily chart. So a lot more volatile, and the reason for this is all of this, well, most of the stocks are mid cap and small cap, and they're very volatile stocks. Some of them are actually foreign stocks as well. So, and they're also low-priced stocks. So all of this combines to add to the volatility of this fund. This could be a good thing or a bad thing. The obvious thing is that there's all those gaps here, and it's a very choppy chart compared to price of chart of gold itself. So we're back again to the $13 area, and this support has held on numerous times here in the past. Now these two candles here on Thursday and Friday, they certainly look ominous, and we could just gap below the support on Tuesday, and we're off to the races. If we do gap below and continue lower, then let's do a quick measured move target. Again, from the height of the pattern maybe, so that's another 18% or 20% down. That's another $3 down, so GDX could be trading in the $10 area. Of course, an alternative scenario, especially if gold rallies, would be an attempt higher. Now we have resistance here from two of these peaks. So if we do rally, this would be a great place to fail, or continue higher, maybe to the 200-day moving average, possibly even higher. But in any case, this is still very much a bearish security, and for it to become bullish, there needs to be a breakout at least above $17, continuation higher, a pullback, and the support held on this pullback. Alright, that's all for gold. Let's now continue to oil. So this is West Texas Intermediate light crude oil spot price end of day daily chart. I pointed out this rising wedge and this breakdown in my last video, and we had a continuation lower. So this is basically kind of classic bearish security, move down, counter trend, move, breakdown, continuation lower, again counter trend move, another continuation lower. So this is classic bearish security patterns. They're playing out. I mentioned here that my target was in the upper 20s. We did hit that 29.93 just this week. Again, we could continue lower, but the next few charts, I don't normally try to pick bottoms, but it's kind of interesting. I'm gonna show several charts next that are maybe signaling that some sort of an intermediate, possibly even tradable bottom in oil could be very close at hand. So let's look at that next. Okay, so this is XLE, Energy Select Sector SPDR fund, which is dominated by two major oil players, the Exxonmobil and Chevron. But anyways, it's kind of useful. So this kind of looks like a inverse cup and handle, or possibly inverse, a head and shoulders pattern. This is very weak shoulder here. So the way, again, measured move targets, we can do a measured move target, and this is about 15% from the height of the pattern to the breakdown. Now, we're already around 10%, almost 11% down, so another 4 or 5%, and possibly we're going to be, at the target for this move. And traders look for the same thing, and everybody looks at the same chart. So, if the traders look, okay, we have reached our target, or let's go ahead and take profits, many of the traders will do the same thing, and then once they start taking profits, or rather covering their shorts, then we have a short covering rally. So we're getting very close to that level. I think around maybe 50. What is it? What did I say? Let me just do another measured move quickly. So this is about $10, and from here, yeah. So we're getting close to maybe around $50 is where this going to start. Now, of course, this is all pure conjecture, and it's possible that we're not going to stop there and just continue lower. And this actually, let me go back for a second. This is EWZ. Look at this huge move. It just sometimes continues, so there's not necessarily going to be a stop there, but it's nevertheless kind of useful. So one more thing on this chart I wanted to point out is this indicator, which is bullish percent index. This measures the number of stocks within XLE, which are on a point and figure buy signal. You can look up what that is. But fact of the matter is, here in August we had 0 of the stocks at on the buy signal, and then we did get a sizable rally. We're basically there. We hit 2.5, almost 0, just 2 days ago. So it's possible that we're going to get some sort of a rally, because it's really quite oversold. Again, I'm not even trying to play it on the upside. I'm only looking in short opportunities, but it's just something to keep in mind while trading. So next, let's look at XOM, which is Exxonmobil. The interesting part about this chart is that while the rest of the stock market was selling really hard and retesting August lows, Exxon actually didn't, and it rallied this week. So that's something. This is a divergence towards the general with the general market, and this is just something to keep in mind. And this is obviously a major oil player. Next, quickly, let's look at XES, which is a S&P 500 Oil and Gas Equipment Servicers Index. Also a kind of like an inverse cup is handle pattern. This is about 21%, and we're basically approaching that 21% mark. So if we do get a like I said about XLE, the same thing. People, traders will look, okay, we're about 20% down, and the target is basically there. So let me take some profits, let me cover some of my short, and then, lo and behold, there is a short cover and rally. So just something to keep in mind also. So next, finally, let's look at natural gas. Okay, this is a natural gas spot price daily end of day price. We had a very powerful short cover and rally here from December into January. The reason why it's short covering is because it's clearly in a bear market, and the reason why it's bear market is because we just hit multi-year lows. So you can't get any more clear than that. Now it seems to have natural gas seems to have run into resistance at this resistance level from this peak here, and then continued lower. We could easily retest this December lows again. This is a very bearish security, and again, I'm only looking for shorting opportunities within it. We could break these levels as well, so we'll see how things play out. But for now, this looks set to continue lower, basically. That's all I want to say about natural gas. Let me quickly show you how to find us on the internet. Please go to MasterChartsTrading.com. We do have a trade alert services that are now active. Please consider subscribing for only $24.95 per month, and you get 3 weeks free trial. I'm getting really good feedback from my subscribers. We're getting some nice trades in and making money. Actually, our account, I will publish this later on here in the performance section, but the account is up while the S&P 500 is down. So that's certainly a positive sign. If you have a minute, please go to our public charts and social page and take a look at this link here. This is where the charts that I mentioned in this video are mostly located. Sign up for our mailing list. You also get a special price for trade alert services. Check out our Twitter, Facebook, YouTube, and StockTwits pages as well. That's it for this week's recap. Thanks for watching and have another great trading week. Bye-bye.